and welcome to the third edition of ETCFO NextGen 2026. We're live from Mumbai and joined by Mr. Jaykumar Shah, CFO at HDB Financial Services. Welcome to the event, Mr. Shah.
Thank you so much.
My first question to you would be, West Asia tensions have been lingering for a good long time. We were, all anticipating whenever the war ends. Kept on stretching February 28th, and it's almost taken over the whole of first quarter. What kind of impact, how are you all seeing on your books and for the sector at large?
So, Shri, that's a very interesting question. I think many a times we forget how local and how granular we are. So, our business today as HDB is absolutely on the ground and local. So, while yes, there has been West Asia crisis, there are a few key components which are very important to note. Number one, what was it all about? It was all about oil flowing or not flowing. It was about gas flowing or not flowing. Now, had those two actually not flown into the country, then yes, we would have had problems, second order, third order, and that's yet to be determined over a period of time. The best thing that the government did is it actually made sure Plan B worked in some shape or form, i.e., at the end of March, they said they had approximately 2.5 months of stock. At the end of May, they've come back and said they've had 2.5 months of stock. So that's oil done. Second, they came and said gas, we were getting it from Oman. Now we're getting it from Qatar, and now we're getting it from Oman. And that's the statement that came in again end of May. Has anything on the ground actually stopped? The answer is no. People have been moving along. Potatoes still sell at the same price, onions still at the same price. A little bit of inflation will come along. Yes,
it has.
The government has already announced and said the inflation is now at 4+. That's already factored in. Can we live with a few extra percentage of pricing and pain? Answer is yes. What really can be a challenge is probably monsoons not coming to the real hinterlands where there is, crops being grown. That is a bigger challenge for people like us who are on the ground in the country, in rural India, to actually think about and make sure that works well.
Right.
So from a West Asia point of view, I think we've moved well. And that's moved on from our point of view.
Did it make you cautious in any of your segments while lending?
I think if I put it in a different manner, what it's really helped is more responsible lending and more responsible borrowing. So in challenging times are probably the best to lend because the lender is more cautious and the borrower is also more cautious. And the industry is also more cautious. So I think it's more good times from a lending point of view where it's good quality that goes out.
Right. The next question I'd ask you is cost of funds for non-bank lenders, right? You come from a parentage of the largest private sector bank, right? The scenario is very different for you. Talk about other NBFCs, they all struggle gathering funding, borrowing to themselves. What strategy, do you see for the other NBFCs and the kind of edge that you bring in? Help us give with a wholesome picture of your cost of funds and, how do other NBFCs grapple with it? What can help them?
So I can't really talk about them beyond the point because I don't know what they do and what they don't. I think the most important thing here is keeping a discipline and keeping a focus. So today, ups and downs will come, crises will come. I've seen right from the global financial crisis, in India over the last 5 to 10 years, ILFS crisis, COVID-1, COVID-2, rates going up, rates going down. If you have a focused approach on how you're going to borrow for your business, if you have a focused approach on what you're going to lend into, that will pass you through the long term. Today in our business, if you ask anybody in the business, they know what we borrow at and what they need to lend at. They know we are here to make money and in a sustainable manner. If we are able to make sure every single person in the organization owns the P&L and owns how we do things, that actually sorts it out for the long term. And then from a borrowing point of view, yes, obviously we have the parentage and we make sure, we work with our parent very closely in terms of, satisfying all the governance norms, etc. So lenders look at us positively from that point of view.
Right.
And, our ability then to reach out to people and make sure that they lend to us at the right rates is also there.
Sure. Another interesting thing that comes to my mind is co-lending. RBI has revised the co-lending norms. It's become effective from 1st of January 2026. 6-7 years when it came in, when RBI introduced it, it was supposed to take off really well. At least those were the expectations in the market. It didn't really. When I speak to banks, they flag underwriting as one of the problems, tech integration as another. What is your view on co-lending? How active are you all on co-lending? What is the opportunity that you see in this segment? And if not, why so?
So again, it's a matter of cost of funds and what capital do you have available, how do you distribute, etc. Today, from a balance sheet point of view and a funding point of view, we're good, and borrowing costs also were very fine in the market. Now, if we have to do co-lending with somebody, it has to actually give me an edge over what I borrow at. For that, there are some opportunities that are there for people like us. Otherwise, we largely like to do it on our own.
Got it. Last question. One of the problems I see on ground for a lot of NBFCs and NBFC MFIs is attrition for people who have their feet on street, collection, underwriting, etc. I would like to understand it from you on what is the attrition and the whole scenario like.
It's very interesting you say it's a problem, right? It's like how we live and breathe in Mumbai. Today, we travel for hours on a day through traffic. Some treat it as a problem, I treat it as an opportunity. It gives me time to read my newspaper, gives me time to talk to my friends, right? So, and gives me time to catch up on things. Now, similarly, today there is an industry where people come in. Today, not everybody's cut out to do sales. Right? When people join the industry, they feel, oh, it feels fancy that I'll do sales from a desk. When you're going and doing retail loans, you're on the ground with the customer. That's the real connect that you're making. Now, if you can do that well, then you're cut out for it. So if you think about attrition, think about it in the first 6 months and then later.
Okay.
First 6 months as the maximum attrition, because that's when people figure out whether they can or cannot do it.
Okay.
Whether they're cut out to do it or not. And the more people stay in the system, they enjoy it. If they're good for it, they'll do more of it. So I don't see it as a challenge. I think it's a transition which people make, and it's a journey.
It doesn't impact your cost.
It's built into it,
and
right?
Process.
I mean, it's built into it. So today, the most beautiful thing I tell people is you make it like a manufacturing plant. If your processes are strong enough, people have to support it. You come in and do the job and move. And as people grow, they will do well for the organization.
Right. Thank you so much, Mr. Shah, for sharing these insights. Stay tuned with us for all the updates.